Hey everybody, this is Mr. Harris, and right now we're going to do the on your own for chapter 16. So this is going to be 16-1. There's really not much for 16-2, but we're going to do 16.3 and 16.4. So there are going to be four different sheets we're going to work on. The first one being the income statement, which we're going to do right now. The first thing we're going to put in is sales amount, and the sales amount is going to be obviously 100% of sales. This amount comes straight from the worksheet that's provided, and it's the sales amount. That's our revenue stream. That's the amount of money we made from selling items at retail price. Now, the next step is the cost of merchandise sold, and here's how we're going to find it. We're going to take the merchandise that was available on January the 1st. So this is going to be the trial balance amount. Remember, trial balance amount. It's going to be $266,960. So that's the amount we start the year with. Then we're going to put in our purchases amount, which is what we add to our already existing inventory. And we're going to add these two up to get our total amount available for sale. So again, that's what we started with plus what we added. The next step is to take away inventory from December the 31st, and that is 251,320. This is found in the balance sheet section, merchandise inventory. So this is what we end the year with, 251,320. We're going to take our total amount minus the inventory to get the cost of merch sold. So we're going to take that minus that, and we're going to get the cost of merchandise sold, which is 203,140. Retail prices obviously are combined of two things. They're combined of cost to get the product into the store and then the money you make on it, which is what we call profit. So we're going to take our sales amount minus the cost of the goods sold, and this is going to give us our gross profit here. So we have 129,120. Next step, let's add up all of our expenses here. And if we add them all up, we get 49,590. So that's the amount of expenses we have. So how do we know if we're getting a net income or not? We're going to take our sales minus the cost of the goods sold to give us our gross profit. So our gross profit right now is 129,000, but that's not the end of the story. We also have to include these expenses here. So we're going to have to take expenses away from this gross profit amount, and we'll do just that. And I got 79,530. So that's the amount of money that we had net worth of net income from our original amount of sales. This is the money we brought in. Here's the cost of the items. Here's the profit. This is all of our expenses, and then lastly our net income. To find out how much each of these numbers is in relation to our net sales, we simply divide the number by the total sales amount. So we're going to hit equals that divided by total sales, and we're going to get 0.61 or 61%. We're going to get 38% here, close to 39. So if our sales represents 100%, our cost of merchandise sold is 61% of net sales. Our gross profit is going to be about 39% of net sales. Our total expenses is going to be about 15% of net sales, and our net income is going to be about 24% of net sales. Moving on, we're going to go to our next sheet right now, which is our net income sheet. So remember that we had a net income here of $79,530. So Karen Grant is one of our partners here. She gets 50% of the net income. Craig Payne here is 50% owner as well, or 50% partner. He gets 50% as well. So our net income amount that we found was $79,530, right? 79,530. Okay, 50% of that net income goes to Karen, so that's 39,765, and 50% goes right to Craig. That's 39,765 as well. That sheet's now done because each one gets 50% of the net income. And for right now, that's how much net income each one gets. So that's the next step here, and really it's quite easy. All right, we're going to move on to sheet 2 here of this same file, and we're going to see that Karen Grant here has a couple of pieces of information, as does Craig, so we're going to fill this stuff in. All right, starting out with the year, we could find this from the trial balance section of the worksheet. We're going to see that Karen has capital as of the beginning of the year of $121,100, right? Now, her share of net income that we found was $39,765. Withdrawals, if we look at the worksheet, we're going to see that Karen withdrew $21,550, right? So this year she made a worth of net income $39,765. She took out $21,550. Therefore, we're going to kind of take the difference between here, and it is going to be a net increase because she made more than she took out. But we're going to find the difference here, and that's going to be $18,215. We're going to do the same thing, or excuse me, we're going to find then capital for the end of the year. So we started off with $121,100. We added $18,215. We're just going to add these two then together, and Karen's new amount of capital is actually going to be, no, we'll put this over here, $139,315. Okay. Next up, we're going to do the same thing for Craig here. Craig's starting capital was $124,440. Net income is going to be the exact same as Karen, $39,765. Over the course of the year, Craig withdrew $22,000. And there is, once again, a net increase there. But we're going to take the difference between those two. We're going to find the net increase to be $17,765. 17,000. Let's put these in the right columns here. So our net capital is then going to be the sum of these two numbers. So at the end of the year, Craig now has a capital of $142,205. We're just going to add these two numbers together then. And we're going to get $281,520. So that's going to be total complete owner's capital for the end of the year of December 31st, 2017. We're going to need to make sure we remember this 281,520 number because we're going to need it in the next document. So we have 3 down. We need to do one more, and that's the balance sheet, right? Balance sheet is over here. Now we already have part of this figured out and filled out, but we get all this information from the worksheet balance sheet section of it. A balance sheet gets one date. It's not for year ended. It's just going to be the last day of the year because a balance sheet is an instantaneous look at a business's situation. It's not done over the course of a year. This is just a one momentary look. So at the current point, cash is $24,490, petty cash is $500, and so forth and so forth. So we're going to add up all of our total assets first. And I got $294,880. Next up, liabilities. Once again, in the balance sheet portion of the provided worksheet. So I'm not writing anything down here that's not already in the book. Now I'm just going to add these up. And I got $13,360. That's our total amount of liabilities. We have accounts payable and sales tax payable. Now we're going to find owner's equity here, right? Karen Grant, let's go back to the previous sheet. Karen Grant's owner's equity is $139,315. Craig Payne, his owner's equity is $142,205. I'm just going to add those together to get total owner's equity. Which should equal $281,520, $281,520. Total owner's equity is good. Now, total liabilities and owner's equity is simply taken that plus total owner's equity. So add these two together and hit enter. I got $294,880. Does that look like our asset number? It does. So in this case, assets equals liabilities plus owner's equity. These two numbers have to match up, which they do, and we have completed all 4 sheets of this section. We completed our income statement, our owner's equity statements, and we concluded here with the balance sheet. Hopefully this will help you out. Thanks.